Canada's post-election fiscal landscape is a mosaic of contradictions, ambitious green energy incentives, growing deficits, and regulatory overhauls that promise both disruption and opportunity. For investors, the challenge lies in parsing these shifts to identify equities that can thrive amid uncertainty while mitigating exposure to policy-driven headwinds. The fiscal tightrope, deficits, debt, and priorities. The Canadian government's 2023 to 2025 fiscal strategy has been marked by a dual focus on reconciliation and climate action, with deficits projected at 40 billion Canadian dollars in 2023-2024 and 39.8 billion Canadian dollars in 2024-2025. While these figures signal a commitment to long-term goals, they also highlight a reliance on borrowing to fund initiatives like the Clean Electricity Investment Tax Credit, ITC, and expanded Indigenous reconciliation programs. By August 2025, public debt charges had risen by 3.8%, driven by higher bond issuance and inflation-linked adjustments. The risk here is twofold. First, elevated deficits could pressure future governments to implement austerity measures or tax hikes, particularly if economic growth falters. Second, the focus on green energy and housing may crowd out support for other sectors, creating winners and losers in the equity market. Investors must weigh whether these policies align with their portfolio's risk profiles. Sector-specific opportunities, clean energy and housing. The clean energy sector is a prime beneficiary of Canada's fiscal pivot. The Clean Electricity ITC, a 15% refundable tax credit for solar, wind, and geothermal projects, has spurred a wave of corporate investment. For example, companies like Brookfield Renewable Partners and Enbridge Inc. are leveraging these incentives to expand their renewable portfolios. The Clean Technology Manufacturing ITC, 30%, further sweetens the deal for firms producing critical materials like lithium and cobalt. Housing, too, is seeing a policy tailwind. The 10% Capital Cost Allowance, CCA, for purpose-built rental housing projects, 2024 to 2030, and the Employee Ownership Trust, EO, tax exemption are designed to stimulate affordable housing development. Developers such as Brixmor Property Group and Crescent Point Energy stand to gain from these measures, though execution risks remain. Corporate taxation, stability amid uncertainty. While corporate tax rates remain unchanged at 15%, general, and 9%, small business, temporary measures like the 100% first-year expensing for certain infrastructure projects offer short-term relief. However, the introduction of the Crypto Asset Reporting Framework, CARF, and stricter compliance penalties under the Income Tax Act signal a broader regulatory tightening. Tech and fintech firms must now navigate heightened scrutiny, which could dampen investor sentiment in the short term.